While the Dow reaching 19,000 is getting a lot of attention this week, it's clear from the charts that really we're into a very broad-based rally for U.S. markets that's quite significant. We're moving now into the strongest time of the year for stocks. It usually starts about the middle of October and runs through about the middle of April or May, depending on the year. This year, the start was delayed a little bit by the U.S. election. People were uncertain as to who was going to win, but it's quite intriguing because the negative effect of the surprise Trump victory only lasted a few hours. In contrast, the surprise decline in the stock market following the Brexit vote lasted about 2 to 3 weeks. This time it lasted 2 to 3 hours. Since then, seasonal factors have taken over and the markets have been working their way higher. What's really interesting about this year is we started off very, very weak in January. That was unusually seasonally. We bottomed out in February, had a nice run through the spring. That's fairly normal seasonally. And then we've been choppy for the last few months. We've been basically going sideways since the early summer. That's pretty common seasonally. So overall, the seasonal factors do seem to be playing out, and we are heading into a more favorable time of year for the markets. Looking at them now, we're looking here at the Dow. Interestingly enough, which is getting a lot of the attention. We can see huge double bottom, big retest here, big double bottom, smaller double bottom, huge retest of support down here, and since then we've been working higher. Initial recovery rally, consolidation at a higher level, rally, consolidation at a higher level. This is a staircase pattern. It's a sign of accumulation. This was the Trump reaction here, very brief, and since then the market's exploded to the upside. This 18,700 former channel resistance level now becomes support. We're continuing to climb. Maybe getting a little bit of a bull trap here with a tiny negative divergence and a little overbought RSI. That tells me short term we could be into a bit of a consolidation here. We may not go screaming higher immediately. We have the U.S. Thanksgiving holiday coming up, so things are likely to go quiet after about noon on Wednesday. I wouldn't be surprised to see this market continue to consolidate here in the 18,800, 850 to 19,000, maybe 19,050 range. But longer term, when people come back from the holiday, the people are still quite positive and enthusiastic about the incoming administration that is being seen as being more friendly towards business. That could help to drive the markets higher. It's not just in a narrow large cap index like the Dow, though. We're also seeing it in the broad indices. And if we look here at the Russell 2000, we can see this one actually broke out first and has been pulling the markets higher. It was trading in a very wide channel. Nice breakout over 1300 here. Huge channel. It has gotten overbought, so again we could see a pause with this 1290 to 1300 resistance zone becoming support. But overall, great breadth when the small cap is actually leading the charge. That's very strong for the overall markets. We're also seeing quite a bit of attention coming onto the S&P here, where it's broken out over 2190, testing 2200. Next measured resistance about 2290, based on this 100-point width of this channel here. Again, we had a double bottom here, a nice initial rally, staircase pattern. Rally, consolidation at higher level. Rally, consolidation at higher level. And in this case, the RSI is not overbought either, so it still technically has room to continue to rally here for the S&P 500. Again, another broader index doing nicely. And looking at the NASDAQ 100, the action here is a little bit interesting. We haven't had quite a breakout in the large cap tech stocks. The reason I think we're seeing that and seeing this lag a little bit is because I think what's happened is that people have been taking profits out of the high-flying, high-value momentum stocks that populate the NASDAQ 100 and using that money to fund purchases of clearly smaller cap names, old economy stocks, infrastructure, manufacturing, industrials. They've been getting some capital. I think this has been the source of funding for some of the money flowing into other parts of the market. However, that being said, even its pattern has been pretty good. Huge double bottom here. Again, this nice staircase accumulation pattern. The RSI is just starting to break out of a downtrend, showing upward momentum. So this has room for a catch-up rally with some of the other indices trading up at new highs. A breakout here, 49.15. Next resistance, this big 5,000 round number here. And if I just show something, I'll bring over the chart for the NASDAQ Composite, which this is a monthly chart going back 20 years. I'm going to move this and just show the NASDAQ Composite recently broke out to an all-time high. It has exceeded the bull market bubble peaks of 2000 and still is trading a couple of points past that. So again, very strong interest in the technology sector in general, even if the big caps themselves are lagging a little bit. One other thing besides seasonality that could help to propel the markets higher in the coming months, seasonality, enthusiasm about a new administration and the prospects for earnings. Another one to keep an eye on here is the dollar index. The U.S. dollar's been screaming higher. This has been a bit of a headwind for stocks and could be for earnings if it stays up, because it makes it more difficult for Americans to export. It makes it cheaper for Americans to travel abroad, and when overseas multinationals bring their earnings back, they come back at a lower level. So you could see a hit to earnings in the next few quarters if this holds up here. However, this is also extremely overbought. You've got a triple top in here, and this above 100 is pricing in probably 4 to 5 rate hikes in 2017. I think that's probably a little bit aggressive for 17. I think you might see 2 or 3. So this has potential for a correction to come back. If this starts to come back, as we saw this year, earnings could start to pick up. That can provide even more fundamental justification for a rally, or at least remove some of the headwinds from the stock market. So if we do see a correction in the U.S. dollar, could also be positive for U.S. stocks. Overall, now we're heading into the Thanksgiving holiday weekend. Wednesday morning brings a flurry of results. We get and other data. We get a lot of it's moved up and crunched in early. So we get jobless claims a day early. We get energy inventories. We get durable goods, consumer sentiment, and Fed minutes. The Fed minutes are likely to point to a December rate hike. That's pretty much baked into the markets and almost a done deal. It would be a massive surprise to the markets if the Fed did not raise interest rates in December. Then we go quiet on Thursday for the Thanksgiving holiday, and then Friday it's light in the markets, but it's Black Friday. Keep an eye on sales and traffic at the stores. People will be looking for that on indications of consumer spending heading into the holiday season. So there's still a lot of news going on under the surface, and there's still a lot going in the markets, even though it's a holiday week from the U.S. Then we come back Monday to Cyber Monday, purchasing stocks and weekend results from the Black Friday sales, and the markets can continue to move along from there. So even though we might go quiet for a few days for the markets, the technical action is very, very strong, and this could continue in the coming weeks with the potential for a Santa Claus rally.